on some of the biggest challenges facing the global economy. And I'm going to start off in China. So China right now faces two intersecting and colliding crises. First, COVID-0. President Xi Jinping's insistence on keeping COVID cases as close to zero as possible has already resulted in lockdowns across China's major cities. Beijing, Shanghai, Shenzhen, and most recently, Chengdu, all locked down. That has resulted in a significant negative impact on growth. The Chinese economy contracted in the second quarter of this year. And looking forward, if we see more cases in more major cities, a repeat performance is quite likely. And the big question of how, in the end, China will learn, as the rest of the world has already learned, to live with the COVID virus and exit from its COVID-0 strategy remains to be answered. On the second crisis, well, this is a picture that I took back in 2012 on a trip to Ordos in Inner Mongolia. Ordos is one of China's famous ghost towns. And back in 2012, we said it was emblematic of a Chinese property sector which was over-leveraged, overbuilt, and on the cusp of a crisis. Well, as so often in economics, we were right on the substance, but not quite right on the timing. It wasn't till a decade later, in 2021, that the big correction in China's real estate sector began. And now we have plunging Chinese real estate sales, plunging Chinese real estate construction, and defaults at major Chinese property developers. Well, if we look around the world and we scan the history books, it's not hard to find examples of real estate crises which have morphed into financial crises. Japan in 1989, the US in the subprime crisis. In China, that's not how we think things are going to play out. China's policymakers still have space to manage the downturn in the real estate sector. China's banks, especially the big state-owned banks, are well-funded and well-capitalized. And that means they've got a cushion to absorb the inevitable increase in bad loans. Even so, when we look at the numbers, our best estimates suggest that China has to shrink real estate supply by about 25% in the years ahead to bring it into line with demand. That is a crunching correction in the sector which, more than any other, has driven China's growth in recent decades and contributed enormously to global demand for commodities. If we pull the pieces together, the COVID-0 lockdowns, the looming question of how to exit from COVID-0, and a drag from real estate which is going to last years rather than months, it's difficult to be optimistic about China's near-term growth prospects. Well, if these were normal times, with all of this bad news coming out of China, when you looked at your news from the Bloomberg news team or monitored the markets on your Bloomberg terminal, it would be China which is driving the narrative. But of course, these are far from normal times. And so when we spin the globe around to the US, we see a very different focus for investors. The obsession on Wall Street is not China right now, it's inflation and what the Fed is going to do to bring it under control. Now, the view in the market is that the Fed doesn't have to do that much to get to grips with sky-high inflation. Market pricing is pointing to a Fed terminal rate at around 4%, and a terminal rate which is held for the briefest of instants before the Fed reverses course and starts to deliver rate cuts in 2023. Now, our view is that that market consensus is underpinned by two assumptions. Neither of them completely wrong, but both of them open to significant question. The first assumption, which is driving the market consensus on the Fed, is that inflation will, in the end, really prove transitory and disappear largely of its own accord. Well, that's partly true. There's a piece of US inflation driven by high energy prices, which could disappear pretty quickly without much intervention by the Fed. But there's also a significant part of US inflation which is being driven by rapid wage gains. As you can see in this chart, unit labor costs in the US right now are rising at a pace which hasn't been seen since the early 1980s. That portion of inflation is going to be sticky and isn't going to go away without significant intervention from the Fed. The second assumption we think the market is making is that the Fed will blink in the face of a recession. Well, we agree that a recession is coming to the US economy. Our models tell us to expect a downturn in the second half of 2023. But we don't think that recession is going to cause the Fed to blink and reverse course. The lesson of the 1970s, a lesson hard-coded into the DNA of every Fed official, is that reversing rate hikes in order to support growth at a moment when inflation is still too high is a recipe for de-anchoring inflation expectations, necessitating an even more severe tightening of monetary policy and an even more painful recession down the line. The market is expecting the Fed to take rates to 4% and then reverse course. The view from our US team is that rates will go to 5% and then stay there. Well, in Europe, the inflation challenge facing the central bank is similar in magnitude. The level of inflation here in Europe is comparable to that in the United States, but very different in nature. Inflation in the United States is driven substantially by sticky wage gains. In Europe, the driver of inflation is very much those transitory factors: rising energy prices, rising food prices. That means that the European Central Bank can hope to contain price pressure with substantially less aggressive tightening. We think that means a 75 basis point hike at the coming meeting as the hawks on the governing council move preemptively against any risk that inflation expectations become de-anchored. And we think the ECB goes to a terminal rate of 1.5%. That's much less than the Fed has to do. Still, we think the combination of sky-high energy prices and tighter financial conditions is enough to tip Europe into recession by the end of this year. And with Italy continuing to grapple with an overhang of debt, the combination of weaker growth and higher borrowing costs could well bring another debt crisis into view. Well, the tour of the horizon hasn't revealed a particularly optimistic picture. We don't think the global economy is heading into a recession. When we bring together our country forecasts, the aggregate view is still the global economy eking out modest growth this year and next. But with China, Europe, and the United States all missing growth targets or sliding into recession, the mood music this year and next will be decidedly negative. What growth there is decidedly muted, and risks firmly tilted to the downside. So, I'm not sure about all of you, but when I think about the series of crises which have hit the global economy in the last few years, the US-China trade war, the COVID shock, Russia's invasion of Ukraine, I sort of wonder, are we just incredibly unlucky? Or is there perhaps some common factor which is causing these crises and making it harder for us to deal with them? So as we meet today, in the shadow of the death of Mikhail Gorbachev, the giant of Russian reform, the man who ended the Cold War, I wanted to use the last couple of minutes of my presentation to think about whether geopolitics could be that factor which is making the world economy more fragile. So, the end of the Cold War was, of course, a moment of significant hubris for us here in the West. History is over, we said. Democracy has won and authoritarians have lost. Free markets have won and state-dominated economies have lost. Well, that was a seductive and influential view. It was also incorrect. As you can see in this chart, the share of global GDP from state-dominated economies isn't falling, it's rising. And I could show you a similar chart showing you that the share of global GDP from authoritarian economies is also on a rising trend. And I think that return of history is a significant explanatory factor behind the crises hitting the global economy. The US-China trade war, the alignment of Western democracies on the side of Ukraine and the authoritarian countries' tacit support for Russia are both in part explained by this return of history. The COVID crisis, well, it's difficult to blame the emergence of that new virus in that Wuhan wet market on geopolitics, but the failures of governments in response to that COVID crisis, a US president who railed against the Kung flu and the China virus, a Chinese government which has so far failed to acquire the Western mRNA vaccines which they need to protect their population and reopen their economy, well, those failures, I think, stem in part from these geopolitical ruptures. The somewhat depressing conclusion that I want to leave you with is that the intensity of the current shocks hitting China, the US, and Europe will fade, but the underlying cause or contributing factor to those shocks in a world increasingly divided between democracy and authoritarianism, free market and state control, that problem will be slow to fade. Thank you.